What's up, everyone? Welcome to the last day, day four, last day of lectures in Module 2, day 4. We have learned about the car purchase decision. We have learned about the housing purchase decision. And then we learned about retirement savings and retirement planning. We're going to switch gears for the rest of the course. And we're going to begin thinking about, not the entire rest of the course, but at least for the next several lectures, we're going to begin thinking about investments. And so after we thought about retirement, I feel it's appropriate to start to talk about, how you might try to invest your retirement funds. In our retirement need analysis, we had to assume a rate of return on our investment. In the next several lectures, you're going to learn how to dial into that exact rate, choosing different financial instruments such as stocks, bonds, mutual funds, and the like. So here we go. This little chapter here is just a primer to get you going and understanding how the whole investment process works. So we're going to cover when it's time for you to begin investing. Then we're going to think about markets, right? So once you decide you want to invest, how do you do it, right? If you need food, you go to the grocery. If you need to invest, where do you go for that? Well, you go to stock markets. And so we're going to think about these security exchanges. I'm going to talk about how to execute an order, and we're not going to do it quite yet, but at the end of next module, you guys are going to actually be buying and selling stocks on the live market in a stock market simulator for prizes. Actually get to do these transactions. I'm going to give you a budget. Of course, you're not spending your own money here, but and we'll see who makes the most money. And I think I have the top 4 people get prizes. So take notes now, learn this stuff, and then when it comes to investing later in the class, you'll be ready to go. All right, a time to invest. So check out this video when thinking about investment.
Every successful investor must begin by understanding the difference between saving, investing, and speculating. If you get those confused, you run the risk of losing a lot of money. Let's start with saving. Saving can be defined as the process of setting money aside in order to make a purchase a short time in the future, typically under 3 years. The most important element when it comes to saving is the safety of your money. You don't want the value of your savings to fluctuate because you'll need all of it to make your purchase. There are several options available to help you save money: savings accounts, money market accounts, and certificates of deposit, for example. Unfortunately, as a trade-off for protecting your money, saving typically pays interest at a rate that is just a bit higher than inflation. If you want to earn more than that, you'll have to look to investing. Unlike saving, investing is a long-term process. It often involves committing a portion of your money to owning a share of a business, with the expectation that you'll receive a higher return than inflation. The most important factor in investing is the growth of your money, and there are many ways to invest, with stocks, bonds, and real estate being the most popular. However, once again, there's a trade-off. While investing typically offers better returns than saving, it also carries more risk, as the value of your investment bounces up and down, at least when looked at in the short term. To be a successful investor, you must invest your money for at least 3 years. That's because, over longer periods, the value of your money will appreciate enough so that even if the value of your investment falls over a short period of time, it will still be higher at the end of the period than it would have been if your money had been sitting in a savings account.
So I want to highlight what's on this slide because this is what is very important about investing versus savings. So savings, you predict a very linear return on your investment. So you pick something very safe, so it's not volatile at all. When it comes to investing, we're going to study how you can pick a bunch of stocks to go from very little value to very high value in your accounts. And so this is something like for retirement. You may start here with your retirement account investing in some stocks and maybe something pretty aggressive. And And you may see your retirement do a lot of fluctuations, which is scary. It's always scary to see your retirement account dip. But the story of the stock market is if you keep it in over a long period of time, it finishes up, right? The stock market's always trending upward. Now, there's some things we can do to not take on a bunch of risk, and maybe we don't want to track the market directly because there are some investment risks there, but we can be just slightly lower and still get some positive returns. That's going to come through a concept called diversification, and we'll get to that towards the end of this.
But what if you need to grow your money quickly? That's where speculating comes in. Speculating involves putting your money at risk with the hope that you will earn a high return in a short period of time. Day trading is a good example of speculating, where stock trades are opened and closed in a period of minutes or hours. Speculators can win big, but they can also lose everything. So, to sum up, save to protect your money, invest to grow your money, speculate to gamble your money.
All right, so we're going to be thinking about investing, right? Growing your money. So you don't plan to touch it for a long time. It's going to fluctuate and then be something potentially high in the end. But before we get there, the things that you need to have taken care of before you invest, you have to have sufficient savings for emergencies. So we talked about building up that emergency fund when looking at liquidity ratio. The rule of thumb is to have enough funds in your savings account for 6 to 9 months of unemployment. And so you need to have sufficient liquidity. Doesn't make sense to lock up your funds in long-term assets when you can't even guarantee that you'll be able to pay the bills if something bad happens. You also need ample insurance, right? So we don't want to forego some of the more important insurance policies that we might want, like health insurance, for the sake of investing. Because if something bad happens, it's going to take some time to get some money out of our assets to pay for a health claim. So we'd rather have insurance for that. Finally, then we can begin building financial capital. So let's take a look at securities markets. When we think about a securities market, what we think about is usually the New York Stock Exchange, but that's only actually one type. There's actually a type called a primary market. And this is where new securities are sold to the public by an issuer. So if a company wants to sell ownership through stock, they'll have a sale on the primary market. If they want to issue some corporate bonds, they'll have a sale on the primary market. This is when you have a sale of assets from the company to stockholders for the very first time. And these are called initial public offerings. Here's a short clip on how IPOs work.
What is an IPO? Presented by WallStreetSurvivor.com. An initial public offering, or IPO, is the very first time a private company issues stock to the public. A company can decide to issue stock for a number of reasons, including to raise money for growth, or to allow employees, owners, and early investors to liquidate some of their shares and make money. To explain how an IPO works, let's look at Dave. Dave owns a chain of very successful food trucks in Chicago. But Dave sees a bigger future for his business and wants to expand his operation to other cities. To do so, he decides to issue shares to the public to raise the necessary cash he needs to build more trucks, inventory, marketing, and staff. Dave can't just issue stock himself to the public. He needs to use an investment bank. If the IPO is big enough, a company can use multiple investment banks. But since Dave's offering is small, he uses one, J.P. Stanley. Based on the value of Dave's company, Dave and J.P. Stanley determine the IPO price, the amount of shares they will use, and the percentage of ownership of Dave's food trucks they will give up. J.P. Stanley values Dave's food trucks at $100 million, and Dave decides to sell 10% of his company. 10% of $100 million means Dave will be raising $10 million. The investment bank decides they will be issuing $1 million in shares to the public at $10 apiece. The investment bank then lists the shares on a stock exchange for the public to buy. Investors can now buy shares of Dave's food truck. In the late 1990s, IPOs really took off as technology startups were issuing stock and raising a ton of money extremely quickly. This led to the internet bubble, and subsequent collapse. You can buy publicly traded companies for free on wallstreetsurvivor.com.
Okay, so when a company wants to raise money to do more stuff, to expand, to invest in new ventures, they can do it in several ways. One way is by debt. They could borrow using bonds, and the other is to sell stock, which is ownership in their company. IPOs in stock basically invite people to share in the gains and losses of that company. So the people who buy into the 10% ownership of the firm have a claim to 10% of the profits. So they're going to be earning based on the profits of the company, and they'll get paid based off that 10%. So, however, the market we're probably more familiar with, and the one we're going to talk about most, is a secondary market. This is when existing securities are traded between investors. So I can sell my stock to you through a stockbroker, and that would be on the secondary market because these stocks have been in existence for a while. When a stock is bought and sold between you and I, it's not going to generate any money for the company anymore. That already happened when they did the IPO. But what it will do is generate gains and losses for me and you, the shareholders. So when we think about the transaction on the secondary market, how do I reach you? How do you sell your stock to me when I can't see you and I might be trading with somebody in London? Who knows? Well, we have to have intermediaries. And one type of market, and markets are sometimes designated around these types of transactions. And so one type of market is called a broker market. And this is kind of like the New York Stock Exchange. This is when party A buys and sells from party B directly, and it is brokered by a stockbroker who charges a commission per trade. So I'm going to take you on a little field trip here to the New York Stock Exchange. We're going to get a tour around the facility, and you can see how a transaction is made on the stock floor or on the trading floor.
Welcome. I'm Ted Weisberg, and I want to welcome you to the New York floor, the New York Stock Exchange, and I'm going to take you on a tour of the exchange. We're in what we call the main room, and you need to look at this beautiful ceiling because this is a spectacular room that has been here as long as the exchange has been here, which is well over 100 years. The specialists are at the kiosks that we see around us, trading different stocks, and the brokers communicating with their clients are lined all around the room. So now what I do as a broker, my responsibility is to represent my clients on the trading floor. I guess I should bid 95, right? Buying the stock as cheaply as I can or selling it as dearly as I can. And I call the client the dog. The dog can live in London. The dog can live in San Francisco. The dog is the decision maker. All I'm doing is implementing that process. So we just got an order. And so what I'm going to do is I'm going to enter this order, trades right here electronically, and then we'll go over and see what the stock looks like. See, we're going to go to where this particular stock trades. So it trades at post 4 section S. So we walk around post 4. This is all Goldman Sachs Spear leads. They're the dealers in all these stocks. The stock is the GGP. GGP, can you tell me how GGP is? GGP is 30,000 off of it, 21 cents right now. Right. Let's give you a name up now. Thank you very much. A broker, of course,
Did you hear what he said? There is somebody who has an offer right now of 30,000 shares at 21 cents. And so he just got an order for some amount of shares at some price. And so what he's going to do is work the deal and whatever the order is, try to make the transaction happen based on what's the lowest price, which was 21 cents.
Has his orders, but he's always looking up to get a sense of what the market is doing, reading the headlines, looking at what oil's doing, look at what gold is doing, looking at what the Dow is doing, looking at the currencies, and I guess if he needs to know, looking at what time it is around the world. Well, when I come to work every day, this is exactly where I come. This is Seaport Securities location on the trading floor. My clerk, Lewis, is here, and Lewis, come say hello. And we actually are on the trading floor about 8 or 8:15 every morning. Lewis is here, and I think a lot of money changes hands. A lot of money. Is it gambling? I guess it's all in the eyes of the beholder. Certainly, there is a huge risk element to it. So if there's risk, I guess it's fair to say it is a form of gambling. I don't choose to see it that way. If I want to gamble, I go to Las Vegas. And now, to continue our tour, this is the podium where they ring the bell. And at 4 o'clock, they ring a bell, and trading ends. Somebody presses a button, the bell goes off, a hammer down, like at the docket, and it's over. And it happens at exactly 4 o'clock every day. It's never changed. And luckily, in these bad markets, I'm glad it's over at 4 o'clock, because if by 4 o'clock you've had enough, you just want to go home.
Okay, so that's what the floor looks like. And that would be like a broker market. Now, he did mention a dealer, and so there are many different types of dealer markets. And this one's a little bit interesting. So dealers keep inventories of securities. So they buy up bunches of stock at a time and own them, and they're called the market makers because at any time they could change their prices and affect the way transactions happen. So let's look at dealers a little bit more detail. Dealers are going to buy a bunch of stocks. When individuals want to buy, they can buy from dealers. And so what happens is the dealer maintains what's called a spread, a bid-ask spread. And so the ask is the lowest sale price offered by the dealer. And so they're going to always ask, even though I'm saying low sale price, they want to ask something above the bid because they want to be buying stocks from people below what they're selling them for. So the ask is what the dealer is willing to sell it to you for, and the bid is what they're willing to buy it from you. Okay, and so the dealer makes money using this spread, and they can increase or decrease the spread to try to make markets more fluid. But for now, all I want you to know is as you look towards these markets, the ask dealers maintain both a price to sell and a price to buy from stockholders and shareholders. Okay, indices. So when we're investing, we're not just thinking about buying and selling individual stocks, especially when we think about building portfolios and buying mutual funds, which are combinations of stocks. We might want to get an idea for how markets are doing in general. And so one thing we can look at are indices. So investors use indices to measure the market's performance. And so let's get an idea what the most popular indices are.
What is an index? Presented by WallStreetSurvivor.com. An index is a quick and easy way to get an idea about how a general market is performing. Here's Jessica. Jessica is in high school and is running for class president. Before the election, Jessica wants to see how she stands to find out what her chances are of winning. The problem is her class is 500 people, and asking everyone will be too much work. So what's the alternative? Instead, Jessica decides to poll a sample of students to at least get an idea of the percentage of students that would vote for her. It's not a perfect solution, but it's much easier. Similarly, an index is a sample of stocks that provide a glimpse at the broader market. When you hear someone say the market is up 100 points, the market they're referring to is an index. There are three major U.S. indices: the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite Index. The Dow is the oldest and most famous index. It takes a weighted average of the 30 largest stocks on the New York Stock Exchange.
Okay, so you see that one way that we can measure the performance of the entire stock market is take a sample of 30 stocks and see how they're doing, 30 representative stocks on the New York Stock Exchange.
These 30 stocks are so heavily traded that they represent the majority of the market volume. Therefore, these 30 stocks are generally a good indicator of the entire market. The S&P index takes a weighted average of the 500 most widely held stocks on the market. These 500 stocks account for approximately 70% of the entire market. Most professionals use the S&P's performance as their benchmark. Lastly, the Nasdaq looks at over 3,000 stocks. The NASDAQ used to be an index exclusively for tech stocks, but has grown to include a few stocks from different industries as well. You can learn more about indices by checking out wallstreetsurvivor.com.
All right, so indexes can give us an idea about how stocks are doing on average. And you may have heard of a bull market or a bear market. And so, what does that mean when investors talking about a bull market? Well, a bull market is associated with investor optimism, economic recovery, and expansion. This is when security prices are rising. So the indices are going to be going up. The stocks on average, the weighted average of all stocks should be going up when we're in a bull. A bear market, however, is investor pessimism, represents an economic slowdown, and is when security prices are falling. So we will be in a bear if prices are falling. So I just actually saw this earlier, and I thought I'd bring it up now. The S&P 500, which is a measure of the overall market performance, when it opened today, took a huge drop in stock value and has not rebounded because people are concerned about uncertainty with some of the news headlines coming out of Washington. And this isn't unusual for the market to respond this way. It responded actually very positively to Trump's election because he was very pro growth, pro business. But some of the uncertainty has got some people rattled today, and it may recover. But we can see if you probably look at stocks all across the board, your portfolio is probably down today. That's actually true. If we look across the Dow, the S&P 500, and the NASDAQ, they are all down today, several percentage points almost. Okay, executing a trade. Let's take a break for a moment and we'll come back.